We had one of the most exciting trading days that we've witnessed in quite some time here today. Now, we did hear that war broke out between Ukraine and Russia, and markets were getting absolutely annihilated to start the day. We had gap downs across the board. The NASDAQ actually gapped down 3%, and by the end of the day, we rallied back not only that 3% that it had originally lost, but an additional 3% on top of that. So this was definitely one of those sell the rumor, buy the news types of events. Usually it's the opposite, but in this case, people were overly nervous and bearish about the prospects of war. Looks like we had a little bit of a snapback rally here today to offset that. So I'm going to talk about what my feelings are with that in regards to what does that mean for the future? What does it mean for the intermediate term? I also wanted to kind of give you an interesting example of how options Greeks work with a trade that we placed just a couple of days ago that was a bullish trade where the stock is down, but we're actually up 20%, and there's a reason behind that. And then in the trade application example later on tonight, I wanted to focus on a sold put trade from a dividend aristocrat that's nearing an attractive zone from a historical perspective. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 24th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go into our description area and make sure you're signed up for our email distribution list as well. That way you can be notified whenever we get these videos posted. You'd also be privy to receiving special discounts from our business, as is the case with our 22222 sale that I mentioned on Tuesday and that David followed up with you yesterday. That sale, by the way, ends tonight at midnight. It will shut off automatically, and so you got a couple more hours if you haven't taken advantage of that quite yet. Also, we are heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And this was one of the more memorable days that we've seen in quite some time. Obviously, most of you know by now that Russia has taken steps to invade Ukraine, and we hope that there's not too much loss of life. Obviously, we don't want to kind of glaze over that. There's definitely a humanitarian impact of what's taking place there, but naturally, this video focuses more on kind of the trading aspect side of what happens now. And as we came into the market here this morning, we were down significantly. In fact, the NASDAQ was down 3% at its lows. Remember, 3% for an index is massive. And if that were the end of the story, that would already be interesting enough to have a conversation about. But it didn't end there. We had one of the most epic rallies that we've ever seen. And by the end of the day, the NASDAQ was up 3%. So we went from being down 3% to being up 3% throughout the day as the markets perhaps use this as, one of those sell the rumor, buy the news type of event where it felt like things were going to be really terrible if there was a war that broke out. And now that it has, now that markets can kind of recognize that perhaps a war in Ukraine will not affect the profitability of many of the American companies that we focus on here. Perhaps this is one of those rug pull types of days that you guys have heard me describe before. Sometimes I refer to it as a flush the toilet moment, where all the weak hands go spiraling down the toilet and only the strong hands survive, and they're the ones that end up being victorious on days like this. Now, obviously, we've still got a long ways to go before we consider the markets to be bullish, but it did feel like things had been getting a little bit out of control in terms of the selling in recent weeks. We've seen a lot of those, cluster signals showing up, not just on individual stocks, but also on some of the main indices. And so today was one of those massive snapback rallies, and we might very well get an opportunity to see some further bullishness in coming days. The real question is this an opportunity for the market to say, today was it? It was the day where we now have a bottom that is set, and now we are going to coast to all-time highs again. I personally am a little bit hesitant to suggest that that might be the case. Then again, as I take the temperature of other folks who are commenting on this sort of thing on CNBC and Bloomberg and Fox Business, etc., it kind of seems to me like everybody else feels that same way. In other words, very few people are saying, this was it, this was the bottom, and now we're off to all-time highs. And so sometimes the market does a good job to hurt as many people as it can. And you never know. If everybody's saying, well, this is just a temporary bounce and everybody's expecting it to go nowhere, then maybe the market does have something else in store. Maybe we will rally into the summer. So we obviously want to remain flexible in our thinking, and that's why we bring you these videos as often as we do here. Each day after the market close, at least when we're in town. David does have a vacation planned for next week, and so he won't be with us to do the Market Outlook videos at that time. And by the way, I think the last time that he went on vacation, we actually saw a pretty big market rally. The old joke used to be when David would go on vacation, start buying your puts because we're about ready to see a market that melts down. But it almost seems like he reversed the curse last time around when he took his European trip. So let's all cross our fingers. We've got some bullishness in store when David's on vacation next week. So anyway, as you can see here, a very green day with what I had mentioned before. What started as an absolutely atrocious day where we had almost all stocks lower to begin the day, gapping lower across the board, and then led to buying throughout the day as the market wanted to kind of come to its senses and look for value that had started to emerge in recent weeks. And so you can see that today was also noteworthy for being a risk-on day. Remember, what we've been seeing more often than not in the last couple of weeks, really for the last couple of months, is that when we have green days, more times than not, it has been more of the defensive areas of the market that have been leading. That is not what we experienced here today. Today was a rally led by technology. In fact, the best industry, so if you were to kind of chop down the sectors into various industries, the best industry today was software, and so things like Microsoft and Salesforce.com and Adobe. I mean, massive days there. Look at Adobe up 8%, Salesforce up 7%, ServiceNow up 9%, Intuit up 6%, even the behemoth of Microsoft itself up 5%. Those are some huge moves there. There's Fortinet as well, up 11%. That actually is a stock that we own in one of my Monday classes, so we were happy to see that 11% move there, as that stock had previously been getting really hurt, but today was a nice snapback rally. Part of the story there, by the way, is what's going on with cybersecurity. There's this fear that Russia is not only going to be aggressive in the war fields, but also through the internet. And so companies will need to spend more money to make sure that they're protecting their corporations. And there's a theory that some of that money is going to flow now into those cybersecurity companies, and a lot of those are held within that software industry group. So software was the leading industry group today. Second best industry was semiconductors. Remember, semiconductors are also part of the technology sector, and a stock like NVIDIA would be a good example of a semiconductor company. It was up 6% today. AMD was up 6% today and was up even further after the bell as they announced a buyback. We also saw, by the way, speaking of after the bell, I just posted this a second ago here on Twitter, but Square is ripping higher after hours. Square ended the day at about 95, which was 7% higher on its own right in the normal session, and then after hours is ripping higher even further, all the way up here to around 120 in real time. So we're starting to see some really aggressive behavior. And speaking of Square, I got asked in my question and answer session exactly 1 week ago, what are some beaten up growth compounder stocks? And I specifically identified the fintech area like Square and PayPal by name. And so it's going to be interesting to see if these things can kind of get some legs underneath of them here all of a sudden, now that the market spirits, the animal spirits within the market are kind of coming back a bit more there. So that was interesting to note there as well. And of course, Square and those types of companies are going to be part of that technology group as well. Visa, PayPal, all of them did pretty well here today. So not only was it impressive to see the amount of green at the end of the day today, considering the gap down that the market experienced earlier today, but in addition to that, it was which ones specifically were green were helpful towards the market's cause to the bullish side, because where we had been lacking in recent weeks is help from those areas. We talked about how technology had gotten to the bottom of the sector selector and how rare that was over the last 4 years. Well, now we're starting to see that snapback of that rubber band, and it was an aggressive day for many of those companies. So software, internet, interactive media, semiconductors. Those were some of the whiz-bang areas of this market today, and it gave you the impression that there was literally, people chasing stocks as high as they could go throughout the entire day, from gapping lower to running them into the bell, with being some of the more aggressive risk-on types of areas. So I think the behavior today was quite good and kind of what the market needed after such a tough slog and tough go of things here more recently. You will see that there were some areas within the red that did not manage to emerge out of the red here today. So while pretty much everything was in the red this morning, most of the market got into the green by the end of the day, but some of the areas did stay in the red. And those areas were consumer staples, which we'll talk about a little bit later in my trade application example tonight. You also saw energy, which was a surprise. There was one patch that was a little bit green this morning, and that was actually your energy stocks, because oil was ripping higher, and that happens quite a bit when you have, a skirmish from a geopolitical perspective, especially when we're dealing with, major oil-producing countries like Russia. So we did see oil spiking early this morning. A lot of those oil companies were up, but that entire trade reversed course, just like the opposite happened. So where all those tech stocks started low by gapping lower and ending very high, the opposite happened with the energy stocks. They gapped higher and they ended low. And then lastly, you can also see financials struggled here today. There's some fear there that with all these sanctions that we're imposing upon Russia, that could have an impact on some of the U.S. banks and other financials as well. We are basically outlawing transactions between some Russian banks right now. And so that might have an impact on the profitability of some U.S. banks as well. So a little bit of fear there. So a very interesting day. One of the most interesting days we've ever witnessed. As we come on over here to the main part of the platform now, we can kind of get a sense from a market breadth perspective with advancers and decliners. I've got the S&P 500 pulled up here, and you can see that we did have 317 stocks in the S&P 500 close higher here today. Only 185 closing lower. And again, it was a wipeout this morning. Had we been looking at this morning, it probably would have been a 90% down type of a day. In other words, 90% of the components in the red. By the end of the day, the bulls just completely took over and actually ended up with way more advancers than decliners. So that's great type of behavior if you want to be long the markets. And again, we don't want to overdo it, because just because we had a great day here today doesn't mean that all of a sudden it's all roses and puppy dogs and rainbows out there, right? We still got a long ways to do. We still got a lot of work to do to get back to where we were a few months ago. But at least it's a start, right? And that feels better than what we had been kind of dealing with here in recent weeks. So I would say constructive activity here today, to put it mildly. Let's come on over here to the charts. Remember, on these types of days, I like to bring up this chart 6D here. Let me get rid of that study. There we go. Makes it a little bit easier to see the chart here if I get rid of that one study. But anyway, this chart 6D here, remember, this is part of our custom charts that we offer to our premium members. So all of you that have signed up, we've been thrilled with the amount of people that have signed up here in the last 2 days. Remember, you guys get access to all 50 plus of our charts. And so not only the ones that you see David and I using regularly, like these ones, but also all of the charts that come with the various classes that we teach. teach, all of our 10 different classes that we teach our premium members during the week, including 8 trading rooms and 2 question and answer sessions. So that's a big part of your subscription that you'll have access to for the next 3 years when you're with us. So today we saw obviously a very big up candle here on that green bar. So remember when I was with you on Tuesday, we were talking about this red bar right here and how it got down to the 1% down level. And then yesterday, we nearly got to the 2% down level with those red bars. And you can see how aggressive these days have been here lately. I mean, it's been crazy. And then today, we got this massive rally back higher. And this really doesn't do it justice because this only shows us close over close information. In other words, we were up 1.5% on the S&P 500. And you're probably thinking, well, what's the big deal, Brad? And we've had plenty of days like that. And it's true. You can see right here that we just had a 1.5% move here on February 15th. And we had back-to-back 1.5% moves here on January 28th and the 31st. So that must have been a Friday, Monday. But anyway, it's not the end result that is the impressive action. It's the fact that we gapped significantly lower, which doesn't show up in this end result, and we rallied all of that to get back to break even. So for the S&P 500, we were down over 2% gapping lower. So not only did we make up that 2%, we then went on to tack on another 1.5% beyond that. So from a range perspective, this chart kind of gets undersold here today. It really isn't telling the true story about how emphatic the trading was here today. You can see that naturally when markets go up, the VIX goes down. So you'll see here that as of last night's close, David probably brought this up with you in his presentation last night, but this was actually the highest level for the VIX in the last 1 year of this chart. You can see that this is a 1-year daily chart, and this purple line down below here was at its highest levels. If you kind of use my cursor as a crosshairs there and kind of look towards the left with those crosshairs, this was the highest level of the VIX in the past 1 calendar year, or 1 rolling year, I should say. Is it the highest we've ever seen? Of course not. We back in the coronavirus time period, it got, up there 60, 70, 80. In the 2008, 2009 time period, the VIX got all the way up to like 80 and 90. It was insane. So these are not the most dramatic we've ever seen, but to put things into context, over the last 1 year, that was the biggest amount of volatility that we saw yesterday. And in just 1 day, we went from being a VIX up there closer to 40 to being a VIX now closer to 30 here as things settled out. So not only did we have a massive reversal in equity prices, we saw a massive reversal in volatility to the opposite direction. Another thing I wanted to bring up, some of you saw me tweeting about this already, but I'll bring it up for those of you that don't follow me on Twitter. Today was kind of an interesting candlestick pattern as well. I'm going to come over here to Twitter to kind of highlight that because it's a little bit easier for you to see over there. Let me come over here to my profile, and where did I post that? Here it is. So this is what's referred to as a piercing line candlestick pattern. And a piercing line candlestick pattern, as you can kind of see on the left-hand side here, refers to 2 different days, where the first day is a bearish candle, the second day is a bullish candle, and then how that gets identified is a piercing pattern occurs when a bullish candle on day 2 closes above the middle of day 1's bearish candle. And additionally, the price gaps down on day 2 only for the gap to be filled and then closes significantly into the losses made previously in day 1's bearish candlestick. So you almost had a perfect textbook example of a piercing line pattern here with the S&P 500 in the last couple of days. So you can kind of see a little bit easier here what that looks like, but just take a look at the last 2 days on the S&P 500 and compare it to what you see over here. It's almost a perfect example of that, where you had a massive gap down on day 2. Not only did you fill that gap on day 2, but you kept going and you landed in the upper half of that prior candle's range. That is known as a bullish candlestick pattern, and the expectation is that you get further bullishness beyond that. Now, whether that happens or not is obviously not up to us, but that's what the pattern would suggest. Obviously, if there's a nuclear warhead that goes off in Ukraine or something like that, then all bets are off. But generally speaking, this is positive price action that you'd like to see here. So I found that to be interesting, and again, wanted to share that with you there on Twitter here a little bit earlier. There's actually a lot of stuff going on Twitter here after hours in terms of dividend increases as well. National Storage Affiliates, which has the very interesting ticker symbol of NSA on a day like today, perhaps a little bit more noteworthy there, but they're actually a storage REIT, and they increased their dividend 11% from the prior, I believe, quarter, but over the past full year, that is a 43% increase over the past year for NSA. We also had 3 dividend aristocrats that announced dividend increases just today alone. Albemarle, which is a company that we've had some exposure to in both my trend trading classes and my dividend growth investing classes over the years. They're tied directly into the electric vehicle space because they are a lithium mining company. They raised their dividend for the 28th consecutive year. It was very much an underwhelming dividend increase of only 0.5%, but hey, it's better than nothing, I suppose. The fact that they did it for the 28th straight year is rather noteworthy. We also had another dividend aristocrat, which is Essex Property Trust, so a REIT that's an apartment REIT. They raised their dividend also for the 28th consecutive year, and in their case, they raised the dividend by about 5.2%. And then PLD, which is not an aristocrat but does have a longer history of increasing the dividend, did have a very eye-popping dividend increase of 25% here after the bell. And as I keep scrolling lower, thank you for the shout out, by the way, Carlisle, as well. We appreciate you as one of our great market scholars. David had some great stuff on his Twitter feed here today as well, expecting, big things, a sharp rally after such a massive gap down there. So David did a great job with that call. And then here's that other dividend aristocrat that I had mentioned, Chubb, for their 29th straight year has increased their dividend from 80 cents to 83 cents. So a lot of stuff going on. Remember to follow David and I on Twitter for insight into the markets between presentations. While we're over here, I might as well get this out of the way as well. I appreciate all of you that clicked like for me the last time around when I did the video on Tuesday. I'll be honest with you, I didn't think I'd be doing a full-length video here tonight because when I woke up this morning, there were under 90 people that had liked it. Most of the likes, as you can imagine, come in on the first day after I post the video. And so I figured there probably wouldn't be 10 more people to click like throughout today, but you guys kind of were like the stock market. You started low, and then you surprised me to the upside by the end of the day, and about 13 of you ended up clicking like there. So thank you to those late likers there. That is the reason that we're doing a full-length video for you here tonight, and that will include a trade application example. Had we stayed down there at 90 likes, I wouldn't be doing this full-length video. The video would already be over. So thank you to all of you that help support us with these free presentations that we offer you guys. All we ask out of you, take 5 seconds out of your day and click like for us. That's it. Also, while we're over here, let's talk about the factor selector. This I put together on Tuesday, so it's a couple of days stale at this point, but I don't really have a lot to report here because the rankings were identical to the prior week. We didn't have a single change. Dividend yield continues to be the leading factor, and quality continues to be the lagging factor at this moment in time. Now remember, today was a major day, and today's price activity is not reflected in this because this was posted there using February 22nd's number. So it is possible with such an epic reversal type of a day like today, we might get a bit of a shakeup here in these rankings when I go to post this again next Tuesday. But for right now, just be aware that dividend yield continues to hold up reasonably well in this market environment, whereas a lot of the other companies are not. There was a dividend dividend yielding company, dividend growth company that we've covered in my classes in the past that actually was leading the market today. If I come back on over here and go to the blog, remember You guys can see which companies are up and down the most pre-market by following my 9 at 9 every morning. And as you can imagine, this morning was an interesting one to look at the 9 at 9 because of all the gap downs that were taking place. Now, one of them that caught my eye to the upside was South Jersey Industries. This is a utility stock that we've covered in my dividend classes in the past. It was up 40% here this morning on a buyout offer. And then after that, you can see it was pretty much a clean sweep of energy companies after that. Because like I mentioned to you just a moment ago, energy stocks gapped higher to start the day and then ended lower. So all the rest of these are energy-related companies with the exception of CF Industries. Remember, we had a bullish trade that just rolled off our books on CF Industries here for this presentation last Friday. On the flip side, look at all these stocks that were getting massacred pre-market here this morning. And there were some of them that were just gapping tremendously lower. I mean, double digits in some of these cases, 33%, 16%, 13%, etc. And a lot of those ended up closing green. So again, a wild, wild day. And all you have to do is look at the 9 at 9 and compare what the end results of the day were to kind of get a sense of that just extreme, extreme volatility that we all witnessed in today's market. Also, earlier today, David taught his portfolio management with ETFs class. So that is now posted in here in our trading rooms calendar for those of you that are premium members that want to get his insight. Remember, in that particular class, he does delve into foreign stock ETFs, and therefore, with the geopolitical concerns that are popping up here more recently, perhaps some more interesting analysis from him in that class as a result. Also, as mentioned before, we only have a few more hours left of our 2222 sale. So if you're just catching this now, make sure you're quickly signing up using the coupon code 22OFF, and that does expire at midnight tonight. So if you're watching this on Friday morning instead of Thursday night when I post it, you're out of luck by then. But for those of you that are still watching it on Tuesday, make sure you're taking advantage of that. Remember, that's the largest offer that we have ever given for a brand new subscriber. We've never gone beyond 20% for a new subscriber before. So just because of the uniqueness of the date, we thought we would bump it up to the 22%. So take advantage of that. You could literally say that's the best deal that we've ever offered to somebody new there from a discount perspective. So again, that expires midnight tonight. Also, earlier today, I taught my question and answer session. Many of you were there. If you weren't and you're a premium member, here are some of the topics that we discussed that you're welcome to go and watch the recording on. And so things like an evaluation of long-term debt to capital and some of the outside resources like Zacks and Value Line, the CCC spreadsheet, and other things that we tend to look at in my fundamentally oriented classes, and how to kind of interpret that and when to perceive that as a bit of a risk, and in other cases not to go overboard with punishing a company too much because it does carry debt. So we had a long conversation about that. We also had a conversation about Alliant, which is or Alliant, I'm not sure exactly how you say it, but ticker symbol LNT, as a dividend growth stock, and some of the good and bad aspects of that particular company. We also had a question about looking for high quality dividend stocks after this market sell-off. And that included the next question there as well as a result of the Russian invasion. So I talked about, maybe 5 or 6 different companies that are kind of interest if the markets were to fall a bit further there. So feel free to check out my response to those questions as well. Also got a question about shorting stocks and how we can look in the platform as to whether stocks are available to short or not. And then I got a question about Tesla as well, and some of the pros and cons of thinking about that company from a longer term kind of growth oriented perspective as opposed to a dividend perspective like some of the other questions. So anyway, it was an excellent session today, as is often the case. Feel free to check that out if you are one of our premium members. Let's get back on track with some more Thinkorswim charts now. And let's go ahead and pull up our 4 grid here, which is chart 4B. And you can see here that despite today's epic rallies, we still have strongly bearish postures. And that shouldn't be a surprise. Remember, one day does not make a trend. Today was an important day. Don't get me wrong. It wasn't just a nothing burger. Today was an important day, but one day does not reverse several weeks, if not several months worth of bearish activity. We still have work to do. One thing I'm going to point out right out of the gate with this foregrid here is notice how the labels are all orange up there at the top of all four of those charts. Remember, those labels change colors. Where it says daily range up there, they change colors from either orange to light blue. And when they're orange, like all four of them are today, it basically means what I had referred to earlier already, which is today was a wild day from a volatility perspective when you take in the full effect of the range of the candle. So what we're referring to there is looking at the low of the day and then looking at the high of the day. And is that amount of difference large or small in comparison to what's referred to as the ATR, or average true range, which is effectively a way to get a general sense of recent trading, how big the ranges have been on prior candles. So it should not be a surprise at all for those of you that use this chart to recognize that all of these labels are orange today, because today is going to be one of the bigger range days you are ever going to witness, at least at around these levels. Obviously, as index prices go up over time, naturally the ranges also go up, just because that's the function of mathematics. But in general, from a percentage perspective, today was just utterly massive when it comes to a range. Take a look at the range as an example on the Dow Jones Industrial Average. We moved nearly 1,000 points today alone, from the low at 32,272 all the way up to a high of 33,245. So not quite 1,000, but darn near 1,000 points of difference from high to low in today's session. That completely dwarfed the average true range, which was nearly half of that, just to put that into perspective. And it's not like we've had quiet trading lately. That average true range is already pretty plump because we've had more aggressive trading lately. So it wasn't like an easy hurdle for it to get over. It basically doubled in one day an already high average true range number. It was truly spectacular to witness the reversal that we saw here today. So as you can see, we did have all four of our charts basically closing either at or very, very close to their highs. And remember, that's a positive sign as well. It generally gives you the impression that if the stock market were to have been open another hour or two, we probably could have gotten a further rally. Now, the futures are actually down just a little bit after hours right now, so it doesn't necessarily, have this big call that tomorrow is going to be another epic up day, but it at least sets the table for that possibility, right? And, as long as we don't get devastating news out of Ukraine, Russia, I think that in the very short term, there's a better chance for the markets to go up than down. But again, as I mentioned before, the real question is, where do we go from there? And the way that I'm thinking in my own head personally is we are likely to get a rally from the bulls that started today and could very well take us into the next week or two. But again, it's the same conversation I was having with you guys back here, where when we start touching that moving average, then I want to see how the market responds to that. So if we get another epic rally here out of the S&P 500, and let's say a week or two from right now, we're up here at like 4,400, or 4,500, and we're bumping up on the underside of that falling 30-day moving average, my mindset right now is that I am still going to be on the bearish side of the coin. In other words, I have the mindset that I want to sell the rips. It's hard to do that today because this is day one of the rip, right? And there's that fear that if you were short selling today, you could get run over in the next couple of days. But if we get, let's say a week or two of rallies, and then all of a sudden we find ourselves on the underside of that falling 30-day moving average, you are more likely than not to find me placing more bearish trades in these presentations during those days, if that is what's to occur. Remember, it doesn't have to, but that is what I'm thinking in my head right now, is that we still have downtrends, right? You look at all of these charts, for all the spectacular, ways that you want to describe today's trading, it still doesn't take away from the fact that all of these charts are still downtrending, right? All of them have the dark pink background telling us that we have strongly bearish intermediate postures, and all of them have these red moving averages telling us that price is below a falling moving average. So in other words, the path of least resistance from an intermediate perspective continues to be to the downside. But that can change, right? So we have to be open-minded enough towards that possibility that if we were to get up to those moving averages and then we start crossing up and through them and spending time above them, then I'm willing to change my mind. That's what you should do as well. When markets change, you should also be willing to be flexible around those markets. But you also have to go into trading with a certain set of assumptions. So my assumption right now is that we're about to embark upon a short-term rally that will bring us back towards the moving averages. It's at that point where my expectations right now are that we're more likely to fail than to succeed when we test them. But if I'm proven wrong, I'm perfectly happy to go to the other side of the coin as well. And if the markets can prove it to me that they want to stay above the moving averages, so be it. Let's start putting on a lot more aggressive bullish trades at that point. But until then, I'm going to remain a bit hesitant, right? And it's because I've been trained to, right? We've already seen what's happened previously when we've approached those moving averages. They've been rejecting any advances towards those moving averages. So is this time going to be different? Well, we'll all find out together, but right now my assumption is let's remain a little bit cautious and hesitant around that point and still keep our eyes open towards opportunities. Remember, there's different ways to approach the markets. Those of you that attend my Tuesday morning dividend growth investing class know that we want to look for longer-term opportunities when we have sell-offs like we've had here more recently. But in that regard, we're willing to hold stocks for many years. This particular presentation, the Market Outlook video, caters to those of you that are a bit more short-term oriented. And so from that perspective, I think it pays to be a little bit more hesitant despite the really aggressive behavior that we saw here today. Notice that we did have a nearly rare signal here from the NASDAQ down below, which would be referred to as a bearish intermediate confirmation signal. We didn't quite get it, so I can't really say that it's official, but we were nearly there, and we could very well have it tomorrow. Remember, a bearish intermediate confirmation signal is the opposite of what you are more commonly hearing us refer to as the bullish intermediate confirmation signal. A bearish intermediate confirmation signal happens when the green line is bearish, like it is right now in the lower reversal zone, on the same day that the red momentum line gets into the upper reversal zone. And again, that's that concept of selling the rips. So we nearly got to that point in one day. What makes that, so spectacular is just yesterday we had our oversold cluster signal. So to go from an oversold cluster signal on one day to having that red line spike into the upper reversal zone the very next day is rather interesting as well. So we didn't quite get there, but just be on the lookout for that possibility tomorrow. If we have another big update tomorrow and that green line still is in the lower reversal zone and the red line's in the upper reversal zone, then that might be one of those sell the rips types of situations. You might have a situation where the NASDAQ can already get up to that moving average in just a day or two. And if that's the case and it struggles there, then that might very well be a time to do some bearish trade. So we'll keep you posted if we recognize that ourselves. Other things of today's charts that I think are interesting are with the Dow Jones Industrial Average and the Russell 2000. Notice that we had long lower shadows today. We talked about that concept back here. This was the day, the January 24th day that will live in infamy because that was the day that I referred to that as a flush the toilet moment. And it wasn't the first time I used that. I actually used that exact phrase a few years ago in a similar situation. But I tried to do my best to explain that process to you at that time, saying that this is very bullish behavior. It might not seem like it at the end of the day. You were barely up, but we were taking out out a previous support area. You can't see it anymore because more days have advanced, but we were taking out like a 3-month horizontal support area. We flushed out all of the weak hands there. We closed higher on the day, and that was, sowing the seeds of an eventual counter trend type of a move up towards that moving average. It took 3 or 4 days to get going, but it finally did get going. Today, I think you can get away with saying we had a similar type of behavior. You see that the Dow had this long lower shadow. It wasn't as long as the lower shadow here on January 24th, but it was in that general vicinity. And I do think a lot of people got flushed out of the market on the gap down this morning. There were a lot of weak hands that just said, I can't handle this. Markets are down again and gapping lower, and now there's war in Europe and this, that, and the other thing. You can get a sense of how especially newer traders would probably feel that way and just throw their hands in the air and say, I'm done. I'm throwing the towel in. I can't handle it anymore. And of course, professionals like market makers like nothing more than to take advantage of situations like that. If you're going to be puking up your shares at the lowest levels, the market makers are happy to take those shares from you and then rally that market for the rest of the day, which is what we saw here today. So I'll be very curious to see if we do get one of these counter trend moves off of today's long lower shadow, similar to what we experienced back here at the end of January. And I do think there's a pretty decent chance for that possibility. So let's keep our eyes open towards that as well. Now, again, notice today's end result for the Dow wasn't all that noteworthy. It was only up 0.28%. So you're not, sitting here saying, wow, what an awesome rally. It's really the low to high that is the impressive aspect of this. So it's got some work to do, but today's a start. So the S&P 500 up 1.5%, Dow Jones up 0.28%. The NASDAQ was today's leader. As I mentioned before, it gapped down 3% to start today. Not only did it get back all 3 of those losing percentage points, it tacked on an additional 3.34% by the end of the day. So we're talking about a move of over 600 basis points here today on the NASDAQ from a percentage perspective. Rather impressive day. And then also Russell 2000 put in an impressive 2.67% today. It actually hit a yearly low before rallying over 2% today. So that low there did take out that prior January low and was lower than every other day over the last year. Remember, some of these other indices were still trading higher than where they were trading about a year ago, but the Russell was a little bit different because it had been lagging for a longer period of time. So it actually hit a new 52-week low today, flushed out all those weak hands, rallied the market, and now we're up there 2.67% to the upside by the time it was all said and done. And you actually end up getting a bullish intermediate confirmation signal there from a body's perspective as well, which tends to bode well for the short-term future. Let's go ahead and now take a look at some 12 grid analysis, and we'll start with chart 5A. These are our asset classes. Remember, it wasn't just stocks that had aggressive days today. I mean, we're talking about aggressive activity all over the place. Just look at the one and only one candle from today on these 12 grids, and you can see exactly what I mean. Look at that candle right there. 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 This one wasn't so big, so foreign bonds was a little bit of a yawn today. But look at that candle right there on high yield bonds. Look at that candle on Bitcoin. Look at the candle on treasury yields. Look at the candle on oil and gold and the dollar. This was not a stock-specific story today. We are talking about volatility across pretty much all financial assets today. Some of them good for the stock-focused ones and anything that would be considered risk on, right? We've had that conversation about Bitcoin here lately, so notice that Bitcoin ripped higher by 5% today as well. So those ended up positive, and then kind of the safety trade unwound in a big way. So, gold had one of the more peculiar candles you'll ever see. Look at GLD here, where we had a really strong trend established. We still do. You can see we still have a strongly bullish posture from an intermediate perspective on gold, but this is the most odd candle that you've seen on gold in probably years. That's how dramatic today was. We had this epic rally in gold, what appeared to be a rally at the start of the day, completely unwound. Gold actually finished lower by 0.65%. Remember, when you see this candle in red like this, it basically means you had a gap up and sold off for the rest of the day. Think of that as blood red there. And it was not ugly, or it was not pretty, I should say, in the gold market from the point of anybody who bought the open, right? Some people probably were, just as aggressive getting into gold today as some people were aggressive getting out of stocks because they were so paranoid about war breaking out. They're like, let me buy gold. And if they bought the open, they got hammered. They got hosed. They are already down pretty significantly there on GLD as you unwound all of that. In fact, closed lower than yesterday's low. Not only did you close lower than yesterday's closing price, but you actually closed today lower than yesterday's low price. That would have been almost unheard of to believe at the market open here today, but that was the type of day that we just experienced. Oil closed a little bit higher today, but just barely. And again, similar to what you see there with gold, this is a filled-in candle, meaning that you gapped higher and you finished well below the opening price. Now, the reason this one is black and this one is red is because gold actually closed lower than yesterday's closing price. Oil still finished a little bit higher today. Barely, only 10 cents on USO here. But because it finished 10 cents higher than yesterday's close, it's filled in black instead. If it had fallen an additional 11 cents, then that would also be filled in red, just like gold was. But both of them are very bearish from a one candlestick perspective. That's not the type of behavior you want to see there. The US dollar had an aggressive gap up, but unlike gold and oil, it did not fill in that gap, right? Gold and oil completely filled in their gaps from the start of the morning. US dollar with UUP here gapped higher, in fact, hit a new 3-month intra-day high by the time it was all said and done, and then sold off a bit throughout the day, but did not close all the way back to where we closed yesterday. So that's why you still see this air pocket here on UUP. So it was still a very strong day for the dollar. Being up 0.82% is a big move for such a substantial currency, but even it was trading in the lower half of its range once it started trading there. With some of these other charts here, be aware that treasuries had a little bit of a volatile day as well. We did see interest rates pull back a little bit. Remember some of the ideas behind this market where, risk assets have gotten hammered here recently, some of it as a result of Ukraine-Russia. There is some conversation going on out there that all of the very bold talk that we've heard from the Fed here in the last couple of months, where they're going to be raising interest rates aggressively, some of that has been dialed back. Now, there is still very much an expectation that there will be an interest rate hike in March, but previously the expectation was going to be 50 basis points. Now I think the market's kind of coming back in line with the idea of only a 25 basis point hike, partly because of the deterioration of financial assets that we've seen. And, there's been a legitimate impact. I mean, some of the AAII retail sentiment numbers are some of the worst readings that we've seen since the coronavirus lows in terms of how do retail traders and investors feel about the market right now. They're the most bearish that they've been. And so I think the Fed sees this and might look at it as an opportunity to say, you know what, maybe we don't need to be so aggressive and be shot out of a cannon right out of the gate. Maybe we need to kind of ease our way into it. So we did see a little bit of a pullback in interest rates today, perhaps as a result of some of that type of thinking there. You'll notice that emerging markets still had a really bad day. They were down 2%, where the S&P 500 was up 1.5% today. But keep in mind the reason behind that. We actually saw some positive developments in other emerging markets, but the problem is Russia is still considered an emerging market right now. Russia, if you pull up RSX, was down 19% just today. And remember, they were already hammered dramatically earlier this week. So in just the last 3 months, Russia is down 46% in 3 months. I mean, can you imagine if the United States stock market was down 46% in 3 months? I mean, even if the stock market was down 46% in 3 years, there would be panic in the streets. So there is just sheer selling taking place over in Russia. And since Russia is part of the emerging markets, it's having a negative impact on EEM right now. Let's also take a look at things from a sector perspective here today. So this will be chart 5C. And you can see that all of our charts are still pink. That should make sense. Remember, when we were looking at our foregrid from the broader index perspective, we still have strongly bearish postures across the board. So it's not a surprise that all of these are still pink. What's more surprising to me on a day like today is that we still had sectors that were lower. Most of them did close in the green, but as I mentioned when we were looking at the heat map, specific areas like the U.S. banks struggled today. So notice that XLF was still down 1.2% at the end of today. We also noticed that reversal with energy stocks. So whereas they gapped higher, they closed lower. So XLE was actually down 0.78% today. Materials were down as well, maybe a little bit of a sympathy play there with oil. They were not down quite as much, but still down 0.29% today. But then the other big one was consumer staples there. And notice that consumer staples gapped lower. They were able to recover a lot of their gains, but they weren't able to completely fill in that gap like you saw with technology up 3.4% today, or even discretionary up 2.29% today. There's now a gap that has emerged there on the staples chart, and remember, that's not a good sign. It is a good sign that we have this long lower shadow, but I think things looked a little bit better when I was last with you within the staples a couple of days ago when they were closer to that moving average. Now, I did identify to you at that time, I said, you've got to be careful there because the path of least resistance is still to the downside. It was just that it was holding up on a relative basis better than the other sectors. So I wanted to point that out. But I was saying that, it doesn't look healthy because you're still trading below the moving average. Now we're seeing on staples an actual breakdown. Notice how we broke down below some of those support levels there of the last few weeks as well. So not a great look there for staples to gap lower, not fill the gap by the end of the day, and still close the end of the day as the worst sector here today, 1.72 to the downside. Speaking of staples, let's now talk about our trade application example. So I'm going to pull up chart 2A. Now, I've been doing a lot of these different types of sold put chart or trade setups here lately. So some of you should be getting more familiar with this technique if you've been watching these presentations. On that point, I also, before I get too far with the current trade idea, wanted to share something that caught my eye today and might be useful from an educational perspective for some of you as well. Remember on Tuesday, my trade application example was a sold put on Home Depot. It was on this day when it was absolutely getting annihilated off of earnings. And so we sold I believe it was the April 250 put. Let me come back over here to the trade tab real quick and just verify that. Yeah, it was the April 250 put. And remember, we got that trade done in the middle of the day. It was about noon my time when we got that one done. And it was filled at a price of $2.50. Now you'll notice here 2 days later, we are up 20% on that trade. We've already made $50 on that. So being up 20% on a sold put trade isn't necessarily anything all that noteworthy, even if it is happening in just 2 days. But the part that is interesting to me and might be educational for some of you as well is Home Depot is down from where it was 2 days ago. Remember, when you're selling a put, it's a bullish trade. So you might be asking yourself, well, how in the world can we be up 20% on our bullish trade if Home Depot today is trading lower than where we got filled 2 days ago? And the reason behind that is what many of you are already aware of, but if you're newer to options trading, you'll want to get used to this concept that there are 3 different pricing elements in the Black-Scholes model: price, time, and volatility. And so time is always the beneficiary of the sold put because time is always eroding, right? So that's your theta that you're making, whether you see it or not, as time ticks away because options are a wasting, expiring asset. So when you're selling premium, time is your friend when it's wasting away. So we know it's not time's problem or theta's problem. We can see here that it wasn't delta that helped us out, right? Delta refers to price. Price is lower right here, right now, than where it was when we did that bullish trade 2 days ago. So we know that it wasn't delta that was helping us out with that trade. So that leaves us vega, or volatility. And so the reason we are making money on the Home Depot sold put trade, which is a bullish trade, even though that stock has gone down over the last 2 days, is because of what I had mentioned before about the VIX, right? 2 days ago, the VIX was up here. You saw a VIX spike earlier today. The VIX got all the way up here to 38 earlier today before completely unwinding. And now the VIX finds itself in the middle of that candle from a couple of days ago. So that I found kind of interesting. And a lot of people use that as kind of like an aha moment or a light bulb moment, like, oh, I didn't really understand how all of those puzzle pieces fit together before, but showing that type of an example can help kind of solidify that concept in your mind. And again, that's the type of thing that David and I teach you guys as premium members of Market Scholars. So if you're somewhat newer to that concept and that sounded like a bunch of gobbledygook and you want to get that squared away in your own mind, take advantage of our 22% off deal that expires tonight at midnight. All right, let's get back on over to the trade application example for today. Back to my dividend stair-step chart, 2A. I'm going to pull up a dividend aristocrat. Usually my go-to area when the markets are getting hammered are the dividend aristocrats. There's 65 companies that have managed to raise their dividends for more than 25 years in a row or more. And naturally, like a lot of other companies, they've sold off here recently as well. Kimberly-Clark is the company behind Kleenex and Kotex and other diapers and other paper towels and all that kind of fun stuff. They're a direct competitor to Procter & Gamble. And you can see here that Kimberly-Clark has kind of been moseying their way higher on the charts over the last 10 years. And as we came into 2022, so that's that kind of dotted gray line that you see here, because this is a 10-year weekly candle chart, or weekly bar chart to be precise. But anyway, this dotted gray line that you see right here is where we have the year crossover. So about right there is where Kimberly-Clark was when we started 2022 at about $143. Well, you'll notice Kimberly-Clark has actually sold off pretty aggressively for such a boring company. And we are now back to this level where we appear to have some horizontal support from previous weeks over the last, let's call it, full calendar year. So back here in 2021, it bounced from around this 130 zone here in February. It did it again here in April. It did it here again in June. It almost did it here in July. It did it again here in October. And now that's where we're at once again. You'll notice that some of those days, or some of those weeks, had oversold cluster signals as well with those little green dots there. This time around, we don't have that, but by the time I got out of my class earlier today, remember I taught a 2.5-hour class earlier today, so by the time I got out of that morning class, the market was already in rally mode, and pretty much everything was already starting to head into the green, but one of the areas that wasn't, as I mentioned before, was those consumer staples. And one of the lagging companies within that group was Kimberly-Clark. So while it did end up rallying towards the end of the day a little bit more, we were able to get our 120 strike sold, and we actually were able to do the March contract. Remember, we are in a moment right now where normally my eyes would be drifting towards the April contracts, but because volatility was so high, remember our volatility was as high as 38 on the VIX here today, because volatility is so rich, we have very juicy, plump premiums that we can sell, whereas normally I'd have to go all the way out to April to get an acceptable return on risk, where I'm looking for that 1% return on risk. In this case, I could do the Marches. In fact, we got $1.20 on our fill price, but I believe the high price today was $1.25, so some people were even getting higher prices there. The other thing I would mention about that is I sold the 120s. I did notice on Kimberly-Clark that they do have the 121s and 122s available in the month of March. So some of you that missed the 120 might be able to get done at 121, 122, and I would view those as reasonably acceptable in this case as well, because really I'm just wanting anything into that blue zone there. 122.43 or less on Kimberly-Clark. Remember, that's our average high yield bands, which is basically going back throughout history to look at what are the highest yields investors have been willing to offer Kimberly-Clark shareholders and what are the lowest yields, and then averaging them out and then plotting them on a chart. So the way that you would look at this at a high level is blue is buy and then orange is, sell or overvalued, however you want to say that. So in other words, Kimberly-Clark is a great company to lock down for the long term. If we can get it down here at 122.43 or less, wonderful. And that's why I'm not buying it outright right here at 128. Instead, I'm selling the 120 put, which puts me on the hook for buying the company at 120 in the middle of March. But in return, I get $120 injected into my portfolio. So if this stock just keeps going sideways between now and then, that $120 is mine to keep. Even if it goes lower, I keep the $120 as long as it stays above 120. If it goes below 120, then I'm on the hook for buying it, which I don't mind buying it because it's a high quality dividend growth company at an attractive level where history has suggested that buying in that blue zone has rewarded investors previously. So that's my trade application example for you here tonight. Again, if you got value out of this longer form video, I ask one simple thing out of you. Simply click like for me there on Twitter. As long as we're up and over 100 likes, I'll plan on doing another full-length video for you the next time around on Tuesday. So again, a couple more hours left on our 22% off sale as well for those of you that are newer. But otherwise, David should be back in the saddle with you tomorrow, and I'll look forward to seeing you guys all next week. Take care, everybody. Bye-bye.